Welcome to It's Only Money here on your radio with financial advisors from Edgewater Family Wealth. EdgewaterFamilyWealth.com is the website. I'm here with Tammy and Scott Brown, the Scott Brown and the Tammy, everybody. That's right. Edgewater Family Wealth are the people you want to talk to for all your retirement planning needs and more. We talk about all of the stuff they do on this show, and there's so much. Good morning, gentlemen.
Good morning.
Good morning.
And now we got a 360 camera going on in here. Oh, man. And you can see all the videos and things like that at the website, EdgewaterFamilyWealth.com, plus all the links to past shows. But it has been, I feel like it's been not long enough since I've seen you guys.
Not long enough? Wait a minute.
Wait a minute.
Start that over again.
It's been too long.
No,
There we
okay.
go.
Yeah. It's not, I need a little more time between seeing you guys is what he's trying to say.
I want to miss you a little bit.
Yeah. I need an opportunity to miss you.
Exactly. Always leave them wanting more.
Being polite.
I have a lot of relatives I feel that way about, so it's fine.
You guys get the same treatment I have at home with my fiance who works from home, which is just, you're still here.
Yeah.
Always here. Always here.
And in the kitchen. Oh, there you are in the living room.
Day after day.
Didn't know a
after day.
4-bedroom house could be so small.
Oh, yes.
No, it's great.
You know, a lot of people, you know, when somebody retires, say the man retires. Actually, it was a female client that said this to me and said about her husband, who was a physician. When he retired, she said, "Listen, I married this guy for life, but not for lunch." She was not ready for him to follow her around the house all day.
Yeah, that's a tough one.
Yeah, is that part of the financial therapy that you do when you tell people, like, look, you guys are going to have a lot more free time, which means you're going to be together a lot.
You're going to find out if you really like each other now, 30 some odd years later, you're going to find, it is actually, it is an amazing, or an interesting, I should say, change of life. Retirement's pretty stressful to begin with. You know, a lot of people underestimate how stressed out it's going to make them to lose control of their income to some degree.
That's the first time I've ever heard those words put together.
It is stressful. Yeah, you think, and believe me, you get over the hump. But in the beginning, I would argue the first 4 or 5 months it's a transition, and a lot of high-powered individuals, male or female. She was an executive, let's say, and she's used to solving problems all day and running a company. Now she's kind of walking around the house thinking, who am I? What am I supposed to do? I can watch whatever I want. I can do whatever. It's a weird feeling. In fact, there was a physician was quoted once as saying somebody saw him, in this case, on the street and said, "Hey, didn't you used to be Dr. Jones?" And he's like, "What do you mean? I'm still Dr. Jones, I'm just not practicing," right? It's getting your head around the fact that you're not going to go to work every day, and whatever was your purpose and meaning in life for the last 30 some odd years has now been converted to following your significant other around the house all day. That kind of energy can be overwhelming to both parties.
Wow. Well, I've never thought about that, but that's a very good point. And now I'm terrified for my retirement.
Yeah. Just don't do it.
No, yeah, but that's why I'm staying active. I'm staying focused. And one of the things that we stay focused here on It's Only Money is the numbers with Tammy, everybody.
1, 2, 3.
Every time, man. Every time.
It just makes
I
him
feel
smile
yes.
from ear to ear.
Keep this playing. So, number-wise, we are finally seeing some dent in the housing market.
A dent.
I would say so.
Yeah.
With the decrease that's starting to going down after all the excessive, that we say, the rate hikes that have been happening the past 6 months.
Yeah.
It's, again, nowhere close to like a drop. It's more like a dent. It's
Not a drop, it's a dent.
Yes. We
It's
talked
not
about
a
this
dip, it's a
before.
dent.
Yeah, it's not a dip.
Yeah.
Not a dip.
Dent. But you can fix a dent.
Yeah.
Yes.
That sounds safer.
Yeah, you get one of those rubber suction things and just pop it back out.
Yeah. Can't fix a dip.
You can't fix a dip.
We
No,
can try
even-
that with
like,
the-
if you had a nice cheese dip
Yeah.
and then somebody put a little something wrong in it, you
Yeah.
can't
Can't fix
pull
it.
that out. You can't fix the dip, but a dent, fixable.
Nice.
You can put a dip in your mouth.
Uh-huh.
That's a thing. But you cannot fix a dip. Is that what we've concluded?
Well, I can try that for lunch.
Yeah. I would not do that.
I would love that Tammy, now American citizen, is just like chewing tobacco
Yep.
dip, just spitting into a jar as we do the show,
Copenhagen,
cowboy
yeah.
hat, and an eagle on his shoulder instead of a parrot.
I love
I
it.
did not imagine that, but that's a good idea. Why not? Just on the way home, back all these stuff with a credit card, and then
Is
do
it-
it.
Love it.
Is a dent in the housing market good or bad?
Well, it depends who, like, or where, but let's say in this particular time, it's not bad. It's not bad because we had an excessive rally, and the point that the Fed is trying to do is exactly that. They don't want it to crash.
Mm-mm.
They want it to kind of take it easy.
Yeah, chill out for a minute,
For a
housing
minute.
market. Yeah. Yeah, I mean, I think that where Tammy's going with this is the slowing of the housing market was part of the intention. Most Americans have the predominance of their wealth wrapped up in their homes, the equity of their homes. And if Americans feel wealthy on average when there's a lot of equity in their homes. That's a weird thing, I think, but there's some truth to that, right? So if you have a house and you paid $300,000 for it, now it's worth $4, you got $200,000 worth of equity. You're like, hey, nah, no matter what happens, I'm in pretty good shape. Let's go out to dinner tonight.
Pretty much.
But if you wake up and you paid $300 for a house and it's worth $300 or less, you're like, I don't know. I'm not feeling as rich as I did yesterday. So maybe we stay home and have the mac and cheese. So that's really the goal of the Fed is mac and cheese or go out to dinner. That's really the directive that they're now operating under.
Yeah, mac and cheese.
It's a mac and cheese we're going for. Yeah, we want a mac and cheese landing.
These are all technical terms. You can add them to your It's Only Money technical term list.
Yes.
If you're,
we have a glossary on the website
in case you get lost. So speaking of mac and cheese, there is something now, and that takes us into the inflation talk here, because mac and cheese is served at restaurants, right? Some restaurants.
Some
are good, some are not that good.
It's always a high-end mac and cheese that for some reason costs $17. But yes, it is served there.
Yes.
$17.
They put some breadcrumbs on the top and triple the price.
That's what makes it.
Would you get a dent on it or no dent?
Yeah, I can make a dent in some mac and cheese, I promise you.
Oh, yeah. That's good. That's good. So $17 mac and cheese, etc. And I wonder what is the latest price of a regular mac and cheese meal right now?
The Kraft mac and cheese?
Yeah, well, at a restaurant.
People are like bewildered tuning in right now. What? I have no idea. I mean, you can buy gourmet mac and cheese out at a fancy restaurant in Winter Park or something and pay $25 for the entree, or you can go get your box at Publix and it's, what is it, like $1.79 or something? I don't know.
That's a nice difference.
Yeah.
Keep the rest in your pocket. And
we digress. Back to housing prices.
Back to housing and inflation right here. But before we leave the housing thing, Florida actually has been resistant to all of that. So particularly Miami, we know that, but also Sarasota in the entire country.
Sarasota is the most resilient.
Miami and Sarasota in Florida. They are not suffering from this dent, quite resistant. So
do we know why?
Well, because of high demand and the construction is not keeping up with all the demand, and because of all the people moving, creating this demand.
Yeah, so a lot of folks, we're all aware of this at this point, that a lot of folks are moving to Florida for the lower tax rate. I don't know how much longer that keeps up, but it's certainly continuing. In Miami definitely has a shortage of middle income housing. I do know that because a lot of high tech companies are moving to Miami. Obviously for the warm climate and the favorable tax treatment. With that said, the problem is they're having trouble finding housing for the people that work for them. So regular folks that make, nice incomes, but not crazy incomes, are struggling to find homes in the Miami area. I don't know what's going on in Sarasota. Is that an old affluent retiree situation?
Well, I used to live there. It's a beautiful place.
You're not a retiree.
But I'm not a retiree. I was, as far as I know,
became an American on Tuesday and retired on Wednesday.
Oh, yeah.
I always get in my brain Pensacola and Sarasota confused because they're two soft drink based cities. So in my brain, I'm always like, which one is where?
Cola, soda. Got it. So it took me a second to catch up to you there.
And it's funny because I noticed something. Most people who end up moving from the northern part of the country into Florida. Yeah. Mostly, not all the time. Those who end up settling in like Palm Beach or West Palm area are mostly from like New York, New Jersey, etc. Yeah. And those who settle on the other end of the state are mostly from Chicago or more in the Midwest.
So it's a Midwest versus Northeastern.
Maybe it has to do with the highway, I thought.
Because they just follow 95 and 75. That's like, honey, let's get on an interstate and go south. And that's where they end up. I got it. It's that simple.
Yeah, and there's a story. We can talk about it later.
We should build an interstate to Lake Okeechobee then.
Right.
Fill in the middle.
Right. That would be a good one.
The Chewy Center.
So we know that cars, usually people, when they move from these areas, they use gas, right? And
Mm-hmm.
we know that gas and natural gas are two synthetic energy, kind of, they say. Now, the natural gas we noticed here, and now we're speaking something off that we were talking about.
Yeah.
A lot of investment that's been happening last year, we're trying to focus on commodities and trying to time the market. And we always advise against that because it's a very, very risky,
not going to work
place. Yes. And to prove that, we actually got some numbers on the natural gas.
Yeah, go on.
We, as of yesterday, natural gas, it has actually a rate of 53% down from last year.
It's because they tried to take our stoves.
Yes, exactly.
Oh yeah, that too.
Yeah, there's the big push against or for natural gas, depending on where you're at on a spectrum. But I know it that has to be a little bit of that as well.
Yeah, so maybe when we come back from break, we'll have the pro-natural gassers and the anti-natural gassers conversation. Because I'm completely confused by that.
All right, get your Pepto-Bismol ready. We'll be back with more It's Only Money here on the radio. Welcome back to It's Only Money here on your radio with financial advisors from Edgewater Family Wealth, Tammy and Scott Brown, and we are having fun here, and we hope you are as well. If you want to get a hold of these gentlemen, edgewaterfamilywealth.com is the website where you'll be able to see this sweet 360 camera that we got going on here, all of the high-tech, the videos, and past episodes, blogs, and also financial talk with Tammy, who is just in the middle of doing the numbers, and that means the song has to come back.
Oh, yes.
Twice in one day.
I know. Double whammy. But we were talking about the natural gas and how it actually dipped. What you said,
50% from last year. Yeah.
Wow. And I don't know if you know this, but people still use the natural gas. But it was a political firestorm for natural gas this year.
Oh.
So, is there anything left that hasn't been politicized?
I don't
is there
know.
anything that the red people and the blue people can sit down and agree upon? M&Ms, is everybody still okay?
No, don't open that can of worms.
Oh, not even candy now?
Yeah,
Not
the
even
whole
M&Ms.
thing with the green M&M. You don't want to go down. They don't want to. Let me try to think of something that's not political real fast.
Puppies?
Oh, nope. Sorry, pit bulls.
Yeah,
so it depends on the kind of puppy. So you're never going to be able to do it. We're in that kind of world right now.
All right.
So So natural gas news, because you said you're talking about timing the market.
Yes. So timing the market. It was just that we had a lot of calls last year talking about this. Like, if the market is doing this, the bond market was not a big of a refuge, if you may. We had a drop in it too. So where do I invest my money last year? And we had a lot of those calls, as we said. And some of the ideas were like, hey, how about we invest in commodities? And we always don't advise for that. We actually don't recommend it at all because it's very risky. And that just to the point that we were just saying, there's a lot of factors that play in pricing of these commodities, including natural gas.
Yeah. I mean, do you think the Fed's behavior or the aggressive nature of the rate hikes plays a role in all of that too? To your point, people traveling, people shipping goods, people whatever. If we slow the economy down and the average American doesn't spend as much, clearly we're going to be in a situation where the commodities that drive the economy, pun intended, are going to be affected price-wise. So yeah, it makes perfect sense. It's working. I did see that the unemployment number that was being somewhat stubborn in so much that it's not going up.
No.
Right.
No.
And people say, why would you want unemployment to go? I personally don't. But we know that if unemployment remains low, the inflation pressure will continue because people who are working have money theoretically and they will spend it. So as unemployment ticks up, we typically see a reduction in inflation because the consumer slows down.
Yep. And on the inflation, although we're seeing inflation dropping slowly, not at the pace that we'd like to see.
Yeah.
But now there is a term being thrown around that's called super core inflation.
Super core inflation.
Yeah.
Hey, bro, super core inflation.
Exactly.
That's how I got my abs.
With that voice, yes.
Super core. We don't want a super core meltdown.
We do not.
Yeah. That's like a 3 Mile Island situation,
Yeah.
right? Yeah. So what is super core?
So we talked last week about how we look into headline CPI inflation and core inflation, the differences, why we use them, etc. But then there is this small segment within core that calculates services. the cost of services, whether they go up or down.
Yep.
And that in the past few months has proven to be stubborn. It's not going down.
Right.
So when you dig deeper into it, as in why is it not going down? What is driving that? And by services, I mean the waiters, cleaning services, etc. Jobs that are being performed by people to do services to
and
others.
We're a service economy.
And we are a service economy. So you notice here that the wages for these jobs, if you may, are not stubborn. Only on the contrary, they are even going up.
Yeah, people who do very vital things are finally getting paid, right? Things like being a service person at a restaurant, being a outdoor person who works maybe building carpentry, roofing, landscape. These people are finally, I think, well overdue getting paid for the hard backbreaking work that they do. I think as a country, as a civilization, quote unquote, maybe we're starting to realize the value of these people that do these really hardcore jobs that, frankly, most of us don't want to do, but we desperately need.
Of course.
So I don't really have a huge problem other than this super core issue.
Yeah, and when you see the last number, which is 6.4 right now, you wonder, where did they come up with that number? And it has so many components that it would take us just a day just going by them one by one.
Right.
And that is just what we said within core. But because it's stubborn, it's super core.
Super core.
Yep.
How do you feel about that, Ryan? Super core.
I love super core, bro. Like I'm gonna use that later. I'm going to check the super core 6%. You know who has 6% body fat? This guy.
Super core.
Super core.
Super core has spoken.
So, I mean, the obvious question I think the average listener, and the average listener is also me, would ask is, are we in a good place inflation-wise, bad place?
I wouldn't say bad, but not as good as we like it, right? But
It's getting better.
But it's getting better.
Yeah. It is being somewhat stubborn, but we are so far coming in for a soft landing. So we'll see if that continues. That's the goal, right? Is to slow the economy down without crashing it.
Yeah, I noticed in my algorithms that I'm getting like so many ads for me to buy treasury bonds or
Could be.
It's like it's the one that's government backed, right?
Yeah, you got it right.
Yeah, and they're like, hey, right now you can get like 4%, 5%, and I'm like, man, should I just take all of my monies and throw it into that? Is that that saves debt? But you stopped before saying like that. It's not where people are going right now.
I mean, some people are. There's never, ever going to be a time where you should throw all of your money at anything, right? That's diversification is a critical component of anybody's investment plan. So, I obviously treasuries are up, munis are up. The whole bond market's, at least from a dividend standpoint, paying a lot. Heck, I saw a savings account now, super savings account.
Super
core savings account. It's actually not called that, but it should be over 4%. So, and that's liquid. You can write checks and get a debit card. So that thing's out there as well. That doesn't mean that you should put all your money in it. It doesn't mean the stock market's no longer a viable place to have your money long term. That doesn't mean the bond market. It doesn't mean you shouldn't consider other asset classes like real estate or whatever. What it does mean is if you have cash on hand, if you're a person that, and everybody should have some cash reserve. I don't know what the number is. Some people say 6 months. Some people say 3 months. Some people say a year. Whatever makes you happy. I'm not one of these people that thinks it's 6 months. It should be 6 months and not 6 months in one day. And it shouldn't be 5 months and 30 days. It should be 6 months, Ryan. Only 6 months. That's silly. If 3 months makes you feel good, that's the voice people make when they say it. I don't know. They make a real annoying voice.
Yeah.
But 6 months, 3 months, a year, just whatever. When you say, look, if the roof blows off, the transmission goes out, one of my ne'er-do-well children did something dumb and I need to give him $5,000 or whatever it is, you need to have that kind of money set aside in a place that doesn't fluctuate, because you don't want to put 10 grand into your safe place and then something happens and it's only 8 grand, right? So that's okay. And what these rates mean to that bucket of money is a much better return. So if you can earn 4% or $40 on your 10 grand or whatever it is, right? You would want to do that. Yes. Or yes. I guess that'd be $400. Sorry. Bad at math. You want to be able to maximize that savings. So I suggest that right now, if you have liquid money, it's a really good time to do so. And the other thing I would say is if you're truly a conservative investor, like in your mind, I don't take risk, I don't like stocks. And that's not wrong, by the way. People get all bent out of shape. Are stocks good or they're not good or bad? They're not right and they're not wrong. If you need good long-term growth, it's a great way to do it in quality dividend-paying stocks. If you don't like that, that's okay too. If you can get by on whatever the fixed rates are, 3, 4, 5% that you can get today, then by all means do that. And if you're a conservative person who wants to earn a better return than they've earned over the last 4 or 5 or 10 or 20 years, frankly, now's a good environment for the CD buyer or the bond buyer or the muni buyer or the savings account person. Now's a better time than probably we've seen in the last decade or so.
It's funny to see the level of difference in advertising, though, over the last couple of years, where it's like it was like these are the hot stocks that you pick. Netflix is since we recommended Netflix, it's grown by 13,000%.
Yeah,
and now it's like, hey, this bond will get you like 4.2%.
It's whatever can turn your head, man. It's whatever can turn your head. It's because human beings, as we've discussed numerous times, are pattern seekers, right? So the market's been down. The rates are up. What's an easy thing to sell to somebody right now? That's really what marketing's all about, and we can cover that more when we get back.
All right. And you know the pattern. We talk for a while, and then there's a commercial, and then we come back. That's a pattern-seeking thing you've just done. But while you're doing that, you can go to Edgewater Family Wealth. Like I said, we have links to past episodes. There's blogs there, financial talks with Tammy, and the most important information, how you get in contact with Edgewater Family Wealth. All the email, the phone numbers, everything's there. So we'll be right back with more It's Only Money here on the radio. Welcome back to It's Only Money here on the radio with financial advisors from Edgewater Family Wealth. Scott Brown and Tammy, they're your super cur money advisors. I'm Ryan, and we're hanging out here on the weekend. And I got to tell you, as we were leaving, we were talking about pattern seeking.
Yeah. Human nature.
Human nature. But you gave me during the break a specific word that I had never heard before.
Oh, now I've forgotten the word.
See?
Apophenia.
Apophenia.
It's not Apophenia. Apophenia.
Yeah, that's who Prince was writing songs about, right?
Yes, he was a great artist back in the 80s. Apophenia. But apophenia is a condition by which actually most of us suffer from, which is that we see patterns where they don't exist. Like, and mostly it's just some form of confirming a bias we already have. I read in Barron's magazine this thing, and it said that this stock was going to do well, and a couple of days later, I read it again, and now I've identified a pattern that XYZ stock's going to do well because I, Scott Brown, read it in Barron's magazine, and I only read things that are smart. So therefore, the conclusion that can be reached is that this stock is going to do well, right? Or a red car drove by on Tuesday, and Tuesday the market went up. Therefore, when red cars drive by, the market's going to go up. Now, we all know logically that doesn't make any sense, but human beings are pattern seekers. We've talked about this many times. If I say to you, Ryan, 246, hopefully you can say,
I'm hungry.
Yes, this is what I was afraid of.
Eight would
you
be
can
the
do
answer
the eighth
there,
thing. If I say 357, we can all say
9.
Right, because we're pattern seekers, and we've been taught to seek patterns since we were in kindergarten. Thank you to Mrs. Welch, my kindergarten teacher. I can do that. But it's not very good for investing. Pattern seeking is built into our DNA. Why? Because we know if we hunted by the river, and every time we hunted by the river, there were animals there because they were seeking water, we identified that as a pattern. Animals are at a place where they can get water, therefore we can hunt them and eat them, right? If we didn't seek patterns and we didn't identify patterns, we could not eat and we could not have survived as a species. That is fantastic for surviving as our Neanderthal ancestors did. It is not great for us as investors because we often look for patterns where they don't exist. And again, the problem with that is when you talked earlier, Ryan, about the algorithm finding you. And the algorithms are you never get an ad that pops up and says, this investment did terrible last year, please buy it, right? That's not you're never going to get that ad, right?
True.
But the reality is that's the one you probably should get because all they're going to do is say, hey, last year, this commodity or this stock or this thing did really well, right? How many times did we hear about the FANG stocks previous to the last year?
Oh, not
all
much.
all day long and every day, right?
Oh, I thought you meant right now. I'm
I
mean, doing good now.
Previous to now,
Oh,
right?
yeah.
Why is that? Because they were killing it. all those stocks are doing amazing, right? So eventually we got tired of hearing it. Probably somebody had that FANG ETF thing pop up on them 4 or 5 times. And like, that's it. I've had enough. I'm going to buy it. Right in time for it to crater, right? So you're not going to see an ad in Money Magazine or the Wall Street Journal for a mutual fund that's lost money 3 years in a row. Because you know what's lost money 3 years in a row? Is small cap and mid caps have been really struggling over the last little bit. It's been kind of the large cap market, big tech rally, right?
Yeah.
Previous to the last 6 months. Guess what's done the best so far this year?
Small caps.
Small caps, right? Mm-hmm. So nobody approached you last year and said, small caps suck. Would you like to put some money in them, right? Which is really what they should have done, because you would have benefited from that this year. So the pattern-seeking thing, apophenia, the term refers to you finding patterns where they don't exist. Thoughtful people realize that their mind will play tricks on them. They question themselves. They have the ability to metacognate. Do we know what metacognate means?
No.
Of course I do, but please tell our audience.
Yeah, it's the ability to think about why you're thinking about what you're thinking about.
Oh,
wait,
man.
Can you repeat that, please?
It's the ability to think about why you're thinking about what you're thinking about. Why am I thinking this? I think this, and then being able to take it one step further and say, why am I thinking this? Right? I think, I don't know, college football is a great example, right? If you're a Florida State fan, right, you're convinced that your team's the best team in the country every single week, despite the fact that there's a lot of evidence to the contrary, right? Yeah. Even when you lose, you can say, well, we were the better team, even though we lost 43-0 because this, and this, right? Because you want to, identify or confirm your existing bias. So again, being able to stop for a second and say, why am I getting this ad? Why is this mutual fund continually popping up in my feed somewhere? I searched for this thing. And by the way, it did really well the last couple of years. Therefore, it's an easy sell to me, right? Nobody wants to buy anything that's down. It's human nature because of the pattern, right? We say, well, why is it down? It must be bad. Down is bad. Therefore, I will only buy the thing that is up, right? And that's, again, human nature and something we want to work hard to avoid. But, professionals do it too. I mean, I was reading, I got a couple of examples for you of experts gone wrong, right? So back in, I think it was this is from like the mid 90s. Every December, Business Week surveys Wall Street's leading strategies, asking where stocks are headed in the year to come. Over the past decade, the consensus of these experts has been off by 16%. So you say, what the solution is, maybe that I'm not smart enough to figure out the shortcut, but I know there's somebody out there, a quote unquote expert, typically wearing a $3,000 suit and driving a Porsche, that can help me. Right? Because, of course, if you wear a $3,000 suit, it makes you instantly smarter. Yes?
Yes.
These people have been off.
It's the Italian fabric.
It is.
It massages your brain muscles.
Yes, indeed. Those people in those $3,000 suits on average were off by 16%. I would argue that a monkey with a dart could do just as well. Right? So, again, that's why long-term investing makes sense. There are numerous examples. In January of 1980, with gold at $850 an ounce, the U.S. Treasury Secretary William Miller declared, at the moment, it doesn't seem an appropriate time to sell your gold. Now, let me ask you a question. Could there possibly be a more credible source on gold than the Secretary of the Treasury?
Not as far as I know.
Yeah, it dropped 17% the very next day he said that.
No.
Because maybe he said that.
Maybe it's his fault. Maybe it's not. Maybe it's a coincidence. Maybe he just should keep his mouth shut, right? So, again, people who get paid to talk, yours truly generally will, right? So you have to, again, take all that with a grain of salt and go back to the long, boring, non-sexy version of investing, which is to buy quality investments and let them incubate over time.
So when you say experts, because you gentlemen are experts at this, because you're obviously Tammy's a math whiz. He's got all the charts. You been doing this for 30 years. But your advice always seems to be like, slow and steady wins the race. And would you say like the experts that have the shortcut, they're not actually experts though?
I mean, I think they're intelligent people on average. You won't typically see somebody on a CNBC that's an analyst that isn't smart. But smart and thoughtful are not the same thing. Right? You may understand a stock inside and out. You may understand the technical aspects. You may understand the balance sheet. You may understand how much cash they have in the bank. You may understand what their revenue is. You may understand the accounting. You may understand the numerous things that goes into their business. That doesn't mean squat for the stock price over the next week or two, right?
Nope,
right. I mean, people thought they understood Enron. How could this business go wrong? Until it did. You don't know what you don't know. And what I know is time erases your mistakes. If you bought a stock at the wrong time this year, 30 years from now, if it's a quality stock, you're not even going to remember that it was the wrong time. Time will erase a lot of the problems that come with short-term gyrations. And again, we're looking for shortcuts as human beings. The news cycle is very short. Some of these people come on and they literally have 30 seconds to make a point, mention the name of their firm, and basically do some branding. So they say something sexy, because if they came on and said, hey, Joe Kernan, how are you? And he said, what do you got for us today, Scott? And I say, I don't know. I think, who knows what the market's going to do tomorrow, but probably in 20 years, if you own IBM and Coke and Microsoft, you'll do okay. I would never be back on CNBC, right? You have to say something kind of shocking, right? You have to run against the crowd a little bit, because, if you're going with the crowd, that means you're just part of the crowd. But if you go against the crowd, you go against the obvious. Somehow you're smarter than everybody else. You don't have to necessarily be right, and most times they won't be, but you said something different than what everybody's thinking. So hang on a second. This guy's on to something.
Get the attention.
You get attention.
That does not seem like a good plan for investing to follow that, because you got to realize that, they got me. Like, I remember when I first started messing with stocks. I mean, all the flashy stuff on the TV, and the guy that's all of a sudden there's a cartoon bull on there. I'm like, that guy got me for a while. And I'm like, okay, he's got a horn. He's got this, because I saw the other financial channels and it's just a guy talking IBM is up right now. It's not fun to watch.
It's not fun to watch. I mean, he's actually the guy on the other channel that's boring is just giving you information. What you do with it's up to you. The guy with the horns and the bull sound and the sell button.
Yeah.
That guy, that's just entertainment. It's just to keep you tuned in so they can sell you whatever's in the next ad, right? They have to keep your attention. If you go on television, if they invited me on CNBC or Fox Business or whatever network it is, and I just said, hey man, everything's cool, just hang in there and buy quality stuff, again, I would never be invited back.
Oh man, I'm hoping you have a real hot take when you come back, though. Something insane. I don't know what he's gonna do, audience. That's why you got to stay tuned to It's Only Money here on the radio. EdgewaterFamilyWealth.com is the website you want to go to get a hold of Scott and Tammy, and we'll be right back with more It's Only Money. Welcome back to It's Only Money. I'm here with financial advisors Scott Brown and Tammy from Edgewater Family Wealth. Check out EdgewaterFamilyWealth.com. A lot of great info, just free. Can you believe it? It's free. Scott is very not good at business when it comes to giving away stuff. You should be charging hundreds of dollars, seminars.
Hundreds of dollars.
Yeah, per ticket.
Ooh.
Well,
there's only 4 of us in the studio, so I mean.
Dude, financial talks with Tammy. Free. It's
free.
Crazy.
It's all free.
Crazy.
All free.
I am here for the people.
Yes, you are. Ed, we're here, and this is the last segment of the show. And I was thinking during the break, you say we're humans, we are pattern seekers, we're full of Apollonia and aphantasia. What was it?
I can't even remember.
Aphonia?
What is it? What has it been?
Aphonia? I don't remember now.
Apophenia.
Yeah. But that's the thing. We are pattern seekers, and there has to be, Scott. I get it. You're looking at things and you're like, oh, the red car drove by, the market went up. So when a red car drives by, the market goes up. That's not real.
Clearly, that's a pattern.
But there has to be some kind of pattern in the market over time, right? There has to be something.
Absolutely.
What's that?
Up. Market goes up. That's the pattern. The market will more than likely be higher in 10 years than it is today. And people say, well, why? Well, because if it's not, then it's severely broken, and it's not severely broken. The market is a voting machine. Tens of millions of investors vote every day on what the value of the market is. So if you say to yourself, the market's, what's the S&P at 33 and some change?
Yeah.
So the market's at 33,000 and some change. I think 10 million people who voted yesterday are all wrong. On average, they're wrong. And I think it's going to go way, way down. I'm not to say the market doesn't get it wrong for a minute. All the voters may change their mind pretty quickly, which is how we get big drops and big rises. But on average, millions of people vote every day by bidding on stock prices as to what they think the market's worth. And they're not wrong. That's actually how we determine what the market's worth, is people bidding and selling and all the things that go into daily trading to come to a price, whether that be the S&P or the Dow. That's the valuation for the day. So again, if you're going to bet against tens of millions of investors who invest every single day, and you're going to bet that the market's going to go from 33,000 to 40,000 tomorrow, that's unlikely. But if you're going to bet over the next 10 years it's going to go from 33,000 to 40,000, there's a better than small chance that could happen, right? Because we know historically that stocks grow. And they grow why? Because the companies that are behind those stocks, IBM, Microsoft, Exxon, Coke, John Deere, whoever it is, get better at what they do. Because if they don't get better, Ryan, guess what happens to them?
They go out of business.
That is correct. That is, what do we call that?
Bankruptcy.
What kind of system do we have here in this country?
Capitalism.
Woo!
Booyah.
Yay! We should have some
Got
bells
that
for
right on the
Kevin,
test.
because he had to take an American test. To become an American, you got to know about capitalism.
They
right?
actually ask you that. Like,
No.
what kind of market system does the United States have?
Did you say broken?
That will not get you into the country.
I don't know, comrade. What kind do you have? No, so we are capitalists, right? And we vote, and the equity markets are our voting machine. We vote for which companies we like the best. And if a company like Apple comes out with a new iPhone and everybody loves it, they get rewarded by more revenue. More revenue means a higher valuation, which means their stock price goes up. If they come out with an iPhone that nobody likes, they get voted on. And if we don't like the iPhone, they get less revenue. People go buy with the Android thing, and that's less revenue for Apple, but more revenue for Google, or who makes Android, right? Is that right?
Depends. The system is mainly like Google.
Mainly Google, right? So that would be a vote for Google and a vote against Apple in that example. That's how markets grow. Companies become more productive, and their stock price reflects that increased productivity. Maybe it's not a good way they become more productive, right? They might come up with a technology that ends up laying off a bunch of people, but they're more productive. They make more revenue and they make higher profits. Therefore, their stock goes up. That's bad for the people that got laid off, but hopefully they find another place to go. So that's the voting machine. That is the market. If you're asking me if there's a pattern, the pattern is if you're 30 years old and you're saving a few $100 a month in your 401k, when you're 60, the pattern will be up. I'll say it right now. I'll be dead probably by the time you find out if I'm right or wrong to that 30-year-old. But the reality is, if you're a 30-year-old, there's a pretty good chance the market's going to be higher than it is today when you go to retire at 60 or 65.
Now, the scientist in me wants to go like, okay, it always goes up, but let's pan out to 10,000 years. Scott could be wrong in 6,900.
You're going to freeze yourself just to prove me wrong?
Yep, yeah. I'm petty like that.
Game on, buddy.
Yeah. But when you say because companies do go out of business, right? It seems like, you have a company like Nintendo, and you're like, we've been around since 1876. You're like, damn, Nintendo, they don't have video games. Then like, we used to make playing cards.
Yes.
Like, what?
Right.
But most companies do have like an average lifespan. They do go in and out of business all the time.
Yeah, they do, or they're absorbed, or they merge, or whatever. And I will, to that point, and I will poke a little hole in my own theory. To that point, we are seeing that cycle speed up. So it used to be, Kodak went out of business, right? Because they didn't believe in the digital technology that was obviously right in front of their face. Kmart, these are companies that maybe 30 years ago would have thought, no way are they going to go out of business. But, it doesn't happen typically overnight. You can kind of see the voting machine already saying Kmart went from 30 to 25 and the votes are not looking good. Now we voted you down to $20 a share. And a lot of people, evacuate the building at that point. So it's the voting machine will tell you what's going on largely. That's why I say rely again on quality stocks. But so back to the original point, which is the cycle of, feast or famine with these companies. It used to take a company like Kmart or Kodak 20, 30, 40, 50 years to go through their cycle and go out of business. Now that cycle is speeding up due to technology. Because of technological innovation, companies are coming and going a little bit quicker than they used to. All that means is just spend a minute more or two on the quality of the issue that you're purchasing. If you're buying a stock, say to yourself, if you're buying Peloton, come on, it's a bicycle with a laptop stuck to it.
Yeah.
Be thoughtful about what you're doing. I'm not saying Peloton. Somebody will probably absorb Peloton and it'll probably be okay. And their shareholders will probably get something out of it. I don't know that for sure, but that's a guess. right? But the reality is, if you're buying Exxon or you're buying Coke or you're buying John Deere or you're buying Caterpillar or Boeing or Lockheed, whatever it is, these Apple, Microsoft, there's a pretty good chance those companies are going to be around. They're large. They have huge R&D programs.
Mm-hmm.
I'm not saying just randomly throw a dart and buy a big stock. What I'm saying is buy quality stocks as best you can determine. And if you determine 10 years from now you bought 10 stocks and 2 of them, the voting machine doesn't look good on those, then you make a change. But you don't do it daily, and you certainly don't do it hourly like some people do.
Is there so the Super Bowl was recently, and the favorite thing that news does is they find a random animal at some place, and they're like, this animal has like a 10-2 record for picking the correct Super Bowl winner, right? And you were telling me earlier, experts for this on average are like 16% off.
Mm-hmm.
We need to find like a kookaburra or like a capuchin monkey or something that can like really throw that dart. And I would be curious to see how it would work, because if there's no patterns, the monkey and the kookaburra both not operating in a pattern, thus breaking the system, fixing your pattern problem.
I think you may be onto something there.
Really boils down to my question is this. So I've jumped into the market at arguably the worst time. Like I had a quick rise with my AMC stock.
Yep.
And but it's been down. So I've only known the pain, you know. You've been doing this a long time, both of you. All right, when it goes back up, because you say the pattern is it goes up, are you even keel both ways the whole time? Like it's down, it's going to be down, but up. Party, woo! You know?
Yeah, I don't care.
No,
either way, don't care. Doesn't affect me. Up or down, it's just part of the. It's like driving a car over uphill or downhill. Still driving a car, still going somewhere. It doesn't. Honestly, I can tell you, it doesn't affect me. I look at the market just because I'm afraid somebody will ask me about it. And as a financial advisor, I should probably look at the market from time to time. I don't know. What is it? A 10,000? Oh, no, that was 10, 15 years ago. Sorry. No, I don't care. I don't care until it zeroes out and the TV turns black and that little line comes together and it all goes off. I'm good. I mean, it's part of,
so bleak.
It's the part of the cycle, right, man? Until I see the mushroom cloud, I'm pretty sure it's going to be okay.
Well, because your point is like the market goes up, so even the down is up from the last down from before. Of
course it is. I mean, that's the lunacy, right? People will do this. They get married to their high water marks, right? This is how they make themselves unhappy. I put in 100,000 10 years ago. It was worth 250,000 last week. Now it's worth 225. Do you think they give a crap about the fact that they grew from 100 to 225? No, they don't care. All they want to talk about is it was 250, now it's 225, right?
Yeah. That was the conversation I had with a family member recently. I was like, oh, how's your 401k doing? And she's like,
terrible.
It's not as good as it was. I mean, I'm down like 30,000, and I'm like, when what did you start with? And she's like, it says like 10,000,
right?
And I'm like, you're doing good then.
Yeah. Well, it's context, right? They look at this little window of time and just because again, we've talked about this human natures. We know what makes us unhappy, and that makes us unhappy. Yes. So we're used to that feeling. When it's up, you're kind of like, yeah. Well, I should have done well, right? Supercore, baby.
Supercore.
Super cool.
You want to go to Supercore website? Go to edgewaterfamilywealth.com. That's how you get in contact with these gentlemen. And I recommend everybody I know to Edgewater Family Wealth, and you'll love it. Trust me on this one. EdgewaterFamilyWealth.com. You get links to past episodes, blogs, financial talks with Tammy, our sweet new 360 camera that we got, so you can focus in on who you want to see talking to.
Does that mean we see things 3D now?
You can put on a VR headset. It's like you're in the room with us.
Ooh.
Yeah, try that out. So thank you guys for hanging out with us and spend another Sunday. Check out EdgewaterFamilyWealth.com, and we'll see you next time on your radio.
Yeah, and clearly people are rich, right? Or wealthy. You don't have to be rich. I like the term wealthy better. I mean, to rich reminds me of like the Monopoly guy or something. But, they're people. They're regular people.
Now that guy I trust. You see the problem, Scott? You don't have a monocle.
Monocle is... Now, if you can meet a guy with a monocle, I mean, like, I'm all in.
What was his financial advice? He said buy Park Place?
Where is that?
Where is that? I can't find it.
Tune in to It's Only Money with Scott Brown from Edgewater Family Wealth. Sunday mornings at 7 on Real Radio 104.1. Raymond James Financial Services, Inc. Member FINRA SIPC. Edgewater Family Wealth is not a broker-dealer, is independent of RJFS.